Hey there traders, have you ever wondered how much your position size impacts your trading results? In today's video, we're diving into the power and importance of options position sizing. We'll compare the outcomes of the same strategy using different position sizes and account sizes to see how it affects risk, returns, and overall performance. Now let's get into it. So the strategy we're going to be backtesting and comparing with different position sizes and account sizes today is from alphacrunching.com. It's the SPX TTR strategy. We're not going to get into the strategy itself today, but if you're interested in learning more about that strategy and some of the results we're seeing here, I'll put a couple links in the description for you to check out after watching this video. So the first version of the position sizing we're going to look at is simply taking one contract at a time. And we're going to start with a small $5,000 account. Now, one thing to kind of know about the strategy is that we are basically risking 300 to make 200. You can see the average loser here for this strategy is $278 and the average winner is $206. So I'm going to loosely say that we're risking 300 to make 200. Again, that's with one spread per trade. So that's sort of our base unit. So if we have a $5,000 account, and we're risking $300 per trade, $300 of a $5,000 account is about 6%. And let me tell you, none of this stuff is a recommendation on account size and position size. We just want to explore these things so you can get an idea of how to put some of this into context for your own account and your own strategies. So we have a 75% win rate. And we average loser is just under 300 and the average winner is just over $200. So when we're starting out with the $5,000 account and we're risking 300, we're basically allocating 6% per trade. But we can see that this strategy made almost $9,000 over the last couple years. And if you think about that same $300, that fixed one spread per trade, as the account gets to $10,000, now we're only risking 3%. So this really isn't allocating based on the size of the account. We're just taking a fixed size and we're looking at what that does over time. So again, 75% win rate. The strategy had a pretty decent P&L curve over time, trading that one contract. But again, the position size itself would actually be decreasing because as the account grows, we're not increasing the size of the position. So that's the first thing we want to kind of look at and compare. All right, so the next thing we're going to do is we're going to take the same $5,000 account, and instead of risking just one contract per trade for the entire 2 years, we're going to allocate 6% per trade. Now, this is extremely high in my opinion. So it's definitely not financial advice that you risk 6% per trade, but in a $5,000 account and you're risking 300, that's essentially what it comes down to even start the strategy. So that's why we're going to, go in with 6%. That's going to start us off with trading one spread per trade. But as the account grows, then it will be taking more spreads per trade, and we'll see what that does to the result. So I'm going to come in here and I'm going to change this to a 6% allocation. And I'm going to remove the max contracts per trade, and we're going to go ahead and let this run. And again, we were running a 75% win rate, and we're risking, about 300 to 200. Okay, so again, still same stats, 75% win rate. We're risking 3 to 2. We're still making about $85 per trade. There was 104 trades here. But look at the account size now. It's now at $13,000. And one of the things, it's kind of hard to see, but we ended up trading up to 3 contracts per trade in the latest one. So this is the power of position sizing and the power of leverage really with options, is that if you position size according to your account size, as the account grows, that those positions would increase. And obviously if the account goes down, you would be decreasing in your size. So this is a pretty good kind of way to compare like fixed contract size versus position sizing in a certain percentage. Again, as you get to larger accounts, 6% is definitely kind of high, but let's change it up a little bit. Let's do the same strategy. We're going to increase the account size to 25,000, and we're going to lower this percentage to something a little bit more acceptable. So let's change the allocation. Let's lower this down to, let's say, 3%. Now, 3% of 25,000 is about $750. So initially, this strategy would be taking 2 spreads per trade, and as the account grows, it would then add a 3rd and 4th spread, so that really no single trade could lose more than 3%. In this case, the starting would be about $750. So let's go ahead and run that and see what this looks like. Again, we've upped the account size to 25%. So we have a larger account size, but we're reducing the allocation, and we want to look at the returns. Now, in the $5,000 account, obviously this is pretty high. It's a CAGR of 101%. That means 100% per year over the last 2 years that it did. But again, that's a higher allocation, which means your drawdown and volatility is going to be greater. And that might be acceptable for a smaller account like 5,000. But as your account size grows or you're trading a larger account, we really want to keep that allocation down so that you can minimize the volatility, but look for decent returns. And we're also going to see the power of leverage in just a strategy like this using options. All right, so again, I keep on reiterating the fact that all the stats are basically the same. The win rate's still 75%. Our average loser and winner is still the same because this is looking at just what one spread is. But now what we're looking at is a smaller allocation. We noticed that the CAGR went down a little bit. It got cut in half to 52%, but so did the max drawdown. The max drawdown of the other allocation from the previous version was, I think, 15%. So our drawdown's being reduced, and we're looking at a 52% return on the entire account, but we're only risking 3% of the portfolio. What that means is that for each trade, you're in for 3%. The rest of the portfolio is actually sitting in cash. Now, that doesn't mean you can't do something else with it, buy an index or trade something else, but this strategy is showing you how you can leverage a small part of your portfolio to achieve really good returns overall. So again, for the $25,000 account, the account grew to just over 54,000 in the course of 2 years. Again, the CAGR on that is 52%. So, pretty good. So let's take it up a notch one more. We're going to go to a $100,000 account, and we're going to, continue to increase our account size, but reduce the allocation. We're going to do a $100,000 account, but we're only going to risk 1% per trade. So 1% of 100,000 is obviously 1,000. So in this particular strategy that risks $300 per spread, that would allow us to start trading the strategy with 3 spreads per trade. And as the account grows, the number of spreads would grow as well. So let's go ahead and run that again, $100,000 allocating 1% per trade. And let's see what that looks like. All right, so that run is done, and we can see a couple things. Again, all the stats are the same. We're still risking the same amount, the amount per trade. We made almost the same amount as the $25,000 account with 3. And that kind of makes sense, right? If we're going from $25,000 account to a $100,000 account, but we reduced the risk by 1/3. So we're essentially making dollar-wise about the same amount with a smaller allocation. This does reduce the drawdown a lot. And this made about 15% on the entire account for almost 2 years in a row. And obviously that varies a little bit. But if we take a look at the number of contracts, towards the end, when the account is largest, we were trading 4 contracts per trade. And if we started out with 3 contracts per trade. So it's really not that much different in the number of contracts per trade. There might have been a period where it went up and went down, but essentially we're incrementally increasing the risk when we do a low allocation like this, like a 1%. Now, with all of these examples, it really shows the power that options have from a leverage standpoint. We all know that buying calls is leverage. This is a credit spread strategy, and we can see how you can leverage a very small amount in a high probability way, very mechanically as well. And you can maybe add this to a portfolio that you're already trading. Maybe you like to trade stocks and you want to add a little bit of options to kind of boost whatever it is you're already doing, or maybe you're a dividend person, or you're just in the indexes and you just want a little bit of an income boost, options trading can really apply that leverage. However, it goes both ways. So let's do this before we go. Let's look at the same $100,000 account, but this time we're going to risk 10%, which is a ridiculous amount. I definitely don't recommend this. Let's review these stats though. With 1%, we had a 15% CAGR, and our drawdown on the entire account was 2.6%. So let's run this with a 10% allocation. And what that basically means is that you're risking, almost $10,000 per trade. I don't know exactly how many contracts that would be, 30 or 40 or something like that. And it's going to grow and shrink as the winners and losers come. So I'm sure the results of this are going to be, oh my gosh, this is, you're going to be a millionaire. This is totally not a recommendation when it comes to the account size. So yes, okay. Realistically, this is not real. However, it does show the power of the leverage. Again, same stats. We ultimately ended up taking 475 contracts towards the end in $1 million account. This is not really, this isn't really realistic, I should say. But look at the drawdown too. As we increase that account, increase the allocation size, we actually got a drawdown of 27%. So these are pretty big swings, but ultimately the stats are the same, and you're increasing. We started off with trading 33 contracts, and as this account grew, we ended up with trading 475 contracts. So again, definitely not a recommendation. I think I'm in the neighborhood of the 1%, maybe 2%. That's kind of where I stand, because I'm really just trying to make, 30 to 40% a year is what ultimately I try to make with my options trading. And then if the market's up, with my longer term investments, that works as well. But that's what I got. If you have any questions about position sizing, or if you want to know what the actual strategy was for this, check the description, and we'll see you in the next video.